Hallelujah. Elon Musk is totally crushing it. I do not see how this deal doesn't get done. Twitter needs to take this deal. The board needs to take this deal. It's a huge premium over where the company was trading. And I'll tell you, this deal is going to revolutionize Twitter. It's going to revolutionize social media. It's going to hopefully restore some freedom of speech in this world. I'm going to explain all of it, including why I think it does happen, despite some of the negativity you're seeing out there in the mainstream media and by the left. Meanwhile, we've got brand new poll numbers that just came in for Joe Biden. You know what? They're not good. They're not good. I feel like a broken record because I say that a lot, but these are actually a whole other thing. Fresh low. Another new low for Joe Biden. We'll talk about that. And then also, amid all this skyrocketing inflation, a lot of people are saying, how do I invest here? What do I do? How do I protect myself? Well, I'm going to be joined today by private equity investor Charlie Dombeck, who says, forget the stock market for just a minute, because you know what? There's a whole other world out there, all kinds of other investment alternatives that you should consider. We got a big, big show today, everyone. Good to have you here. Welcome to the Trish Regan Show. I am Trish. Portions of today's program are brought to you by Legacy Precious Metals. There's never been a better time to invest in precious metals than now. So go to legacypminvestments.com today. Download your free investing guide. Those guys are really terrific. I promise they will hook you up. Use my name. Go check that out. Meanwhile, let's turn to the big news of the day. Elon Musk stunning the world again, causing a whole lot of commotion, including a lot of liberals to get very, very upset on Twitter, after offering to buy the company for $43 billion or $54.20 a share. That's a roughly, 54% premium over where the company was trading before he bought his original 9.2% stake. He said he wanted to become a private company because he's got a whole lot of changes he wants to enact. And in order to do that, it needs to be privately held, so he wants to buy it. I'll tell you this, I think this deal is going to get done. There's some negativity out there. We're seeing, some reports in the press. It can't happen. Well, you know what? Without another suitor out there, it happens. It happens, and it's going to be good for everyone. I'll get into the reasons for that in just a second. But let me first go to what Elon's saying. And I quote, "I invested in Twitter as I believe in its potential to be the platform for free speech around the globe. And I believe free speech is a societal imperative for a functioning democracy." He's right on that. "However, since making my investment, I now realize the company will neither thrive nor serve this societal imperative in its current form. Twitter needs to be transformed as a private company." Employees don't really like that. "As a result, I am offering to buy 100% of Twitter for $54.20 a share in cash, a 54% premium over the day before I began investing in Twitter, and a 38% premium over the day before my investment was publicly announced. My offer is my best," he says, "and my final offer. So if it's not accepted, I would need to reconsider my position as a shareholder." Whoa. Okay, so it's going to happen. I believe it's going to happen. The board, first of all, has to consider it, and they said they're considering it. It's their responsibility to consider it. And I don't see how they say no. I mean, if they did say no, they'd risk getting sued from here to Sunday. Don't forget, Elon owns 9.2% of the stock, right? So if they don't do the deal and he sells the stock plummets. Another reason for investors to sue. So unless they have some other company, some other suitor waiting in the wings that wants to buy this instead of Elon, I don't know how the board turns this down. They just can't, because they have a fiduciary responsibility. And this is a pretty good offer. I mean, it may take some time. I get that boards are, not always receptive to these things. But nonetheless, Twitter did confirm in a press release that it had received Musk's offer and said that the board is considering it. Let me quote from what they said. They said, quote, "We'll carefully review the proposal to determine the course of action that is believed to be in the best interest of the company and all Twitter stockholders." Now, as I said, boards can do stupid things, but the ramifications of doing stupid things and of saying no to $54.20 a share, they're pretty significant. So again, they have a responsibility here to maximize shareholder value. And unless they're going to sit there and tell us the company's really worth 100, which, by the way, it's not, and Wall Street has never thought that it might be. In fact, I think if you look at the last 12-month trading range, the highest it ever got was into the low 70s. So I don't think the board will be able to make the argument that the company's not worth the $54.20 a share. That would be very, very tricky. And of course, it doesn't matter, because if the market doesn't trade up on Elon not being involved, then of course they're still looking at shareholder lawsuits. It's funny though how upset the left gets over all of this. I was looking through Twitter, and one of the ones that stood out to me, and we actually published on my website, trishintel.com, or we have a big article on this, again, trishintel.com, is from former Labor Secretary Robert Reich, who writes, and I quote, "Anyone else concerned about another oligarch taking over a news source?" Okay, Mr. Reich, that's actually pretty disgusting to say, especially at a time like this, to accuse a man like Elon Musk, who has built his business from the ground up, who has done, frankly, so much for this country, and created single-handedly the entire electronic vehicle industry, the electric vehicle industry that you so want. I mean, to accuse him of being an oligarch, that's pretty shameful. But these people, they will stoop to anything. They really will. To all kinds of lows to try to intimidate. Anyway, I would just say that Elon Musk coming into Twitter is good news for Twitter. It's good because let's not forget what this company has done right over the last several years. It's frozen news accounts, the New York Post, for an article that's now been seemingly, getting the stamp of the approval from the New York Times and the Washington Post on Hunter Biden's laptop. They froze the New York Post. They freeze comedy accounts, right? Think of Babylon Bee. They kicked a president off a president of the United States off their platform. This is not appropriate. This is not America. This is not the freedom of speech that we need. This is an attempt to control the narrative by way of big tech censorship. And so for the sake of the country, it needs to change. So thank you to Elon Musk for being so willing to take this on. My advice to Twitter, take the deal. In other news today, there's a new poll that just came out showing that Joe Biden is really doing quite poorly, like more poorly than you might have ever thought. Only 1/3 of the country, 1/3 of American voters, 33%, believe that President Biden is handling his job responsibilities well, according to this new Rasmussen poll. Another poll released today by Gallup shows him slightly better than Rasmussen. However, he's losing ground with some pretty key demographics, including millennials and minorities, down 60% in terms of his support, 20 points, from 60% in terms of his support from millennials to just 40% now. He's also lost about 20 points with Hispanics and African Americans. So, these are important demographics, important groups that he cannot afford to lose. What do we see over and over again? Economic issues are consistently cited as Americans' top concern. I'm going to get into the economy. I'm going to get into how you can protect yourself with everything going on when I'm joined today by KeyCity Capital's Charlie Dombeck. In just a moment, we're going to be talking about how you invest amid all this inflation. But first, I just want to point out, did you see gold nearing $2,000 an ounce again? And no wonder. People are concerned. They're worried right now. They're worried that the value of their dollar is being eroded as we speak. All this money printing from the Federal Reserve, all this money printing from the White House, from our government, is causing lots of inflation because they have that many more dollars in circulation, thereby eroding the value of your dollar. It's the reason why I say you need gold in your portfolio. I mean, we've got 30 trillion and still counting in debt. So there's going to be many challenges aside from the current inflationary environment that we're looking at for your dollars in the future, which is why I encourage you to look at a gold-backed IRA, and the company I recommend is Legacy Precious Metals. They know what they're doing. They're here to help you get the best price, and they're going to work with you to ensure that you have that protection against all this inflation in your portfolio. So give them a ring today. Feel free to use my name. As I've always told you, really, really good guys, and they'll look out for you. So call them today at 1-866-589-0560. Again, that number is 1-866-589-0560. 866-589-0560. Turning now to the overall economy, every read we are getting on inflation right now suggests, you know what, this is just getting worse and worse and worse. I mean, take a look. We've got a chart here of the last 12 months, and what you have seen is a constant escalation in consumer prices. You know what? I'm sorry, but this is all thanks to over-aggressive policy from the Federal Reserve, thank you very much, and over-aggressive policy in spending from the federal government. But Joe Biden does not want you to think that. No. It's not his fault. Not his fault. It's Putin's fault, of course. Listen to him here in Iowa this week.
Putin's invasion of Ukraine has driven up gas prices and food prices all over the world. The two largest grain producers in the world, Ukraine and Russia, are not doing what they usually do, so everything's going up. We saw today's inflation data. 70% of the increase in prices in March came from Putin's price hike in gasoline. We need to address this challenge with an urgency that demands. That's why I've called on Congress to move immediately to lower the cost of families' utility bills, prescription drug bills, and more while lowering the deficit to reduce inflation.
Okay, in other words, let's spend even more money, thereby driving inflation even higher. Look, the reality is Ukraine is going to continue to be a problem, right? And it's going to continue to drive energy prices higher, which drives everything else higher. But in terms of what's been going on already, like the last 12 months, I'm sorry, buddy, that is on you. Joining me right now for a look at when and if this inflation ever ends, whether it will drive us into a recession, and how the heck you invest your money in this environment, is again Charlie Dombeck. We're so glad to have you back with us again. Charlie Dombeck from KeyCity Capital. Good to see you.
It's great to be here, Trish, and you're spot on. The reality is we already had raging inflation in our economy before the Ukraine crisis, and essentially the Biden administration overstimulated the economy by passing out and printing too much money, issuing stimulus checks to individuals and businesses. And with the pandemic, we had all this pent-up demand, and then we put a lot of cash in consumers and businesses' balance sheets that they went out and spent when the pandemic relieved. So that led to the big problem we have today, and it's not just spending, it's supply chain issues. Those issues are going to continue well into the end of 2022 and into 2023 in the first quarter.
So when does it end? I mean, you mentioned into 2023. Is there any sense that it could be over? I don't personally, I think you know this, I don't think so. But, you know, given that you're out there investing every day, I'm curious to get your take on it. Because some people are hopeful, right? They're saying, well, you know, if there's enough pullback in demand, maybe it will actually cause prices to recede.
It's interesting, you know, we were at 8.5% last month, and about 1.5% of that was caused by the Ukraine crisis, not 70% as the Biden administration leads us to believe. The reality is the market hopes that we've reached a peak. Maybe we've gotten close to the top, but the problem is the Federal Reserve has to act very aggressively with interest rate policy to bring inflation down. And we're in a different interest rate environment that we've ever been historically, where in this environment, we have to use interest rate policy to actually push down inflation. And in past cycles, we've used interest rate policy to prevent inflation. It's going to be a long road before we see any relief in inflation. And the reality is, how do we create that soft landing? The Federal Reserve is in a difficult position. If they're too aggressive with interest rate policy, they're going to cool the economy off too quick and possibly push us into a recession.
Yeah, well, you brought up recession. I mean, I think that's an important risk to consider. How realistic is it?
I think there's a very significant risk of a recession in the next 12 months. If you look at history, 13 of the last 16 interest rate increases have resulted in a recession. And if you read the Wall Street Journal this morning, JP Morgan's profit dropped 42% last month. That means banks are starting to see pressure. There's been a significant decline in consumer spending. The economy is cooling off. Inflation is getting into people's checkbooks, and they don't have as much disposable income to spend. So I think we have a lot of risk that we're ultimately going to be in a recessionary environment moving forward. And there's a number of leading indicators that you can look at. We all talk about this bond yield, this yield curve, and when short-term interest rates start to outpace or exceed long-term rates, that's a very significant event and ultimately is a predictor of a future recession. And what I know from looking at bond yields is that short-term interest rates are rising much faster than long-term rates. And when we have a crossover, that is a strong indicator of a recessionary environment. That's something we have to be prepared for and really act in a defensive manner.
So, and by the way, that happened, right? We saw that flashing recently. It was brief, but I think the overall sense right now is that it's heading towards that environment, that inverted yield curve environment, which is troublesome and does indicate, a bumpy sort of future, I guess, over the next year or two. So, Charlie, is this really like what stagflation is then? Because normal market forces would say, well, you're going to see a pullback in prices because there's less demand. But we've got something else going on, which is that there's been so much money printing for so long. You've got the supply chain crisis. You've got what's going on in Ukraine. So as we look out into the future, it feels like the economy may actually start to enter that recessionary environment while simultaneously prices still go up.
So what I would say, we are in a perfect storm for a stagflation environment where we have prolonged high inflation, and because of aggressive interest rate policy, we push our economy into a recession. Mm-hmm. And that spells a lot of trouble for the markets and puts a lot of pressure on our individual economies.
Yeah. So with all that in mind, right, let's get to the sort of punchline here, which is what the heck do you do? I mean, as an investor, how should you be thinking about where to put your money in a time like this?
It's very challenging. The financial markets are not the place to be. In the fixed income environment, the coupon rate that you're earning on your interest-bearing investments is still very low, and people are struggling with having enough cash flow that are on a fixed income budget to be able to support themselves with the inflationary environment we're in today. The equity markets are going to be under a lot of pressure from interest rate increases that we haven't experienced. So we have been moving clients' capital out of the financial markets into assets that represent a store of value, that have hard collateral behind them, that will perform well in a stagflation, in an inflationary environment, that are recession protected. So I like things like precious metal, commodities, energy, healthcare, and of course, passive rental real estate.
Right, which is a big part of what I know you do. And I know you do a lot of different investing on behalf of clients, but you also have a fund that does invest in passive real estate. I mean, I think that the timing on this is important. And by the way, look, I mean, you and I both know real estate doesn't always go up, gold doesn't always go up, and there are times when you might actually see the equity market outperform these other asset classes. But it seems to me a lot of investors are lacking these other asset classes. Maybe they have their own home, right? Like they have that investment. But in terms of investing in other real estate ventures or in some of these other kinds of companies, you mentioned healthcare and some other sort of protective type sectors, there's ways to do it, I guess, without actually being directly in the stock market.
Exactly. The reality is a lot of these off-market investment opportunities aren't available through a traditional financial advisor. And they're not available because largely those financial advisors can't get paid a fee to manage these types of alternative and off-market investment opportunities. So we are a sponsor of these types of off-market investment opportunities. You are direct to an operator who actually owns and operates passive rental real estate funds and investment opportunities, and they're available to the average American. Mm-hmm. The great news is you don't have to pay a fee to get in. And what I know is that rental real estate is going to perform exceptionally well in the environment that we're in today. If you think about it, with rising interest rates, many home buyers are now priced out of the market because the cost to buy a property on a monthly basis is rising. There's still a lack of inventory. There's a shortage, and rents are rising across the nation at an unprecedented rate. In the Sun Belt states, in our jurisdictions, our rental rate increases last year were north of 20%, as much as 35% in Tampa, Florida. And those markets are going to continue to perform exceptionally well. Those are the places you want to park capital in the next economic cycle.
Yeah, no, that's a smart way of looking at it. I mean, some people get nervous around real estate because they say, wait a second, the value of the real estate, it might decline in light of mortgage rates going up. Given the inflationary pressures, I don't necessarily see that to be entirely the case. But the other thing I think you point to, which is relevant here, is that rents are still going up. And in fact, if mortgage rates go up, then maybe fewer people will be buying homes. They'd be more likely to rent.
Exactly. And I ultimately see a cooling off of the single family residential market, and we'll see valuations maybe correct or come down. But in the multifamily space, you are going to experience increased valuation because of the additional cash flow that comes from rental rate increases that result from a rising interest rate environment.
So what's your best piece of advice, do you think, for sort of regular folk investors who...
My best piece of advice is this. Most of my clients that I have worked with over a career of work parked all of their capital in the traditional financial market, stocks, bonds, mutual funds, and ETFs. My proposition is that you can do much better by having some money in financials, some money in passive real estate, some money in alternative investments. And typically in those other two asset classes, you're going to get a higher average annual rate of return. And oftentimes you're going to get an embedded tax strategy in those investments that keep that income off the 1040 during years where you have high active income from your job, the profession you practice, or the business you own. And we can compound dollars that would normally be paid out in the form of income taxes. This leads to a way that you accelerate how you grow your wealth and ultimately reach a point in your financial life. I call it retirement, which is well before normal retirement age, where you have much more flexibility about the things you do during the time of the day, whether you spend it with friends, family, leisure, sport. That is the American dream. We all want to get out of the rat race, right?
Sure. No, and if there's a way to get there without taking on maybe as much, look, everything is filled with risk, but I think a lot of people want to be able to invest responsibly. One other thing I just want to mention before you go, because this is not always what a financial advisor, a personal financial advisor would offer up, and you touched on something earlier, which I think is critical, because there's a system, right, in place. There's a system that works for the financial advisors to pitch certain things, and it's institutionally based.
Absolutely. I mean, the markets are designed to keep your capital in the financial markets. Your financial advisors typically don't want you to invest in these asset classes. They view them as risky. I view them as a complement to what financial advisors do. And oftentimes, the risk in these other asset classes is much less than what we're experiencing in the financial markets, which is particularly true today.
Really interesting stuff. I encourage everybody to check out your firm, KeyCity Capital. We've been speaking with Charlie Dombeck. Charlie, thank you so much. As always, we will see you very soon. Charlie Dombeck from KeyCity Capital. Go to keycitycapital.com for more. Thanks, Charlie.
Thank you.
I told you it was a pretty packed show. Go to my website, trishintel.com, for a whole lot more. Also, make sure you go to our store, to my store. Our freedom-inspired apparel is all right there at trishregan.store. And join me on all the social media platforms, from Twitter to Instagram to also one of my favorites right now, Locals, trishregan.locals.com. I'm going to see you there. Good luck, Elon Musk. The world needs you right now.